We are coming up on this mark. As you look back over the past year, what has been the biggest surprise to you as someone actively involved in these markets?
Good morning, Brian. Thank you for having me on. To me, it's the market resiliency. I mean, it truly is the Teflon market. If someone had told us a year ago that the Trump administration was actually going to go through with all of these reciprocal tariffs, with threatening 100+% tariffs on China, all of these different trade metrics, and the stock market, while volatile earlier this year, just kept sailing away and is at new highs and surging, I think all of us would have been a little bit skeptical. But yet again, this market has shown it is Teflon. Nothing can stick to it, and clearly the bulls are still in control.
Tom, is there more going? So to your point, look, it has been Teflon. We have had tariffs are still in place. We have an ongoing government shutdown. Why? Why is there something underneath the surface of this market besides AI that keeps investors just so optimistic?
So I think it's employment. Obviously, AI is integral to where the S&P 500 is, especially, and that is the linchpin. But as I look beyond the surface, it's employment, right? As long as people have jobs and can get jobs, then they can really weather a lot of uncertainty, inflation, things like that. And the fact that the labor market has stayed so strong, I think, is sort of the unsung hero of this market rally.
Now, Inez, I hear everything Tom is saying, but look, I mean, a large part of this rally is based on AI optimism. Every time OpenAI comes out with another deal, that company sees the potential to raise even more money at a higher valuation. The companies it works with, their stock has tended to trade up.
Yeah, it's this market is being led by AI mostly, and you have analysts that have been talking about the markets going higher because of AI. Yes, you've had the Fed easing, but AI is really the driver here. I will say that over this past year, just looking at this past year, the stunning rally from the April lows has been so notable, where the administration basically shifted to, we are going to spend our way out of this issue, and we are going to invest in all the sort of touch points of energy, of AI, of industrial. I mean, if you look at every single sector that is up right now year to date, it is what the administration has also been looking at. So the chip sector, data centers, electricity generation, all of this is what has been leading this market. And of course, AI being the fundamental theme throughout all of this.
Tom, let me get back to you. Why can't this continue into next year? If tariffs aren't going to take down the market, if the shutdown's not going to take down the market, if higher valuations aren't going to take down the market, we have the Fed out there likely to cut rates a couple more times next year. What hits things here?
Yeah, so as we think about what goes wrong, I think that the simplest way to describe it, it's not that people were wrong to be worried about all these tariffs or policy uncertainty. It's that they expected it to be negative too soon. So the economy is still facing headwinds. The unemployment rate is rising. We are seeing economic metrics come in, but it's not reacting to tariffs and trade uncertainty as fast as everybody expected it to. But just because it doesn't do it as quickly, it doesn't mean it's not going to happen. And I think that, to me, as we look at 2026, I can start painting a case that the stock market is starting to make the economy look better than it really is, because AI is powering the S&P 500 higher, while the rest of these sectors, while not bad, we're starting to see little cracks. And I think that's a big thing to watch in 2026.
Brooke, let me bring you in here. To Tom's point, there are cracks emerging in this economy. I look at what Chipotle said. Starbucks results have started to improve, but still not blowing anyone's minds. We have the SNAP payments now missed. Now the retailer is going to report in a few weeks. I'm seeing cautious notes from Target in my box. I have a story on Yahoo Finance right now looking at Target stock trading at a 52-week low. So it's not all great out there economic-wise.
Brian, I think a key indicator on really how this low and middle income consumer who has been struggling, as all those reports hinted to, will become clear when McDonald's reports this week their latest quarterly earnings. We're certainly keeping a lookout on that, the return to U.S. same-store sales growth, the momentum that they have behind these key value plays, and really leaning into that idea that they can hold and gain back and maintain their value leadership in this sort of environment. And even what we heard once again within that 60 Minutes interview yesterday evening is President Trump really touting that overall grocery prices have gone down. Sure, beef is still bad, but we got egg prices down. These are the key issues that the everyday American, particularly those low and middle income Americans who really have been struggling in the backdrop, really rely on. He's touting that they've come down, but there are some key moments here that we're hearing within these reports, particularly for young people who aren't spending like they did even just last year, and importantly, a few years ago when that stimulus money was really flooding through this economy as well.
Tom, why do you think the market ignores stuff like this?
Because of AI, mostly, and because there's so much bullish momentum. I mean, you guys see this every day. I mean, OpenAI pledges to spend hundreds of billions of dollars with one of like 6 companies, and they just kind of rotate, saying they're going to spend hundreds of billions more, and they just keep going around. All this money has to be acquired, right? All this has to be sourced over the coming years. Yet the market trades as though it's a done deal. And so I think that this constant barrage of AI enthusiasm, optimism, is really helping. It's almost a distraction. And I'm not saying that it's not going to happen and AI isn't going to be the greatest thing in the world. But I think right now these headlines, which in reality don't actually mean much from a bottom line standpoint, are helping to keep investors focused on that excitement. And because of the government shutdown, we're not getting economic data to really provide a counter case. And so I think that it's just keeping people very optimistic.
And as outside of AI, if you go back and if we were having this conversation on November 5th, and someone made a prediction that gold prices would be up at a record at the same time the stock market is at a record, it would be hard to believe. I can get cryptocurrency. You know, President Trump has been very friendly to the cryptocurrency industry, but gold has been the surprise move for me over the past 12 months.
Yeah, and it's up 50% year to date. It's still around the $4,000 level. Look, asset holders have done well in this economy. If you hold stocks, if you hold gold, if you hold metals, even if you held Bitcoin since Trump was elected, asset holders are doing well. So when we talk about this K-shaped economy, yes, it's a K-shaped economy because the higher income ones are the ones that are doing most of the spending and are the ones that are sort of keeping everything afloat. If you listen to what Visa said last week, their high income spenders are the ones that are, driving everything forward. And we've seen this over and over, and we're seeing it when we talk about these earnings report and where the executives are basically pointing out where the spending is coming from and where it's not.
Tom, what are you telling your clients right now, and what questions are they asking you? Is it as simple as saying, hey guys, you've probably made bank this year off of all AI trades, just stay the course? I mean, there's no sign that trade is cracking yet.
So one thing I'm very surprised about by my subscriber base, which is predominantly advisors and investors, is people are very skeptical that this can continue. And it's just sort of a simple idea of the pandemic happens, stocks go up 25%. Interest rates go surging to multi-decade highs, stocks go up 25%. The Trump administration kicks the bucket over on global trade for the past 40 years, stocks go up 25%. And you're getting a lot of people starting to get this late 90s kind of vibe, obviously older investors. They are concerned that the market is essentially ignoring everything and just saying, well, it's just all going to work out great. And so far it has. But despite the very strong performance, it's almost that it's so strong, it's starting to make people nervous.
Do you see any positioning in the options market, Tom? I know you follow options. Is anybody betting against a short-term pullback at all? Anything you could see, any red flags?
No, actually sort of quite the opposite, right? It's sort of all systems are go. And if you look at it last week, I mean, we had these 3 kind of potential speed bumps. You had the U.S.-China trade, you had the big tech earnings, and then you had the Fed decision. The market sailed right through them. I get that Powell was more hawkish but nobody believes they're not going to, cut rates either in December or January. So that's where the concern is coming from. Everybody's on the same side of the trade, and Brian and everybody knows that when everyone's on the wrong side of the trade, it usually does pay to get a little cautious.